We welcome everybody to the TTR Networking Present February version. That's not right, but whatever, there's a word for it, I'm sorry. Understanding your financial footprint. And we're very happy to have Robert Hailey and Brynn Cochran, who are members of our Collaborating Connections group, presenting together today. So I'm just going to give it over to Brynn and Robert and take it away.
Welcome, everyone. Thank you for being part of this networking, understanding your footprint. My name is Robert Hailey. I'm with First Home Bank. I'm a mortgage banker. Been doing it for well over 25 years. Give you wealth and knowledge in that sense. Ms. Brynn. Introduce yourself.
Hi, everybody. Thank you for joining us. Brynn Cochran here with Shelter Insurance. And I've been in the insurance business for almost 3 years. And I now have my own agency with Shelter Insurance, and I also am a brokerage. So I just am grateful for this time for Robert and I to go over your understanding your financial footprint. And Robert is going to take the lead, and I'll chime in from time to time.
All right, great. And as well as I meant to say, we originate business in all 50 states, so that we're a federal chartered bank, so let me be aware of that with First Home Bank. If you can move to the next slide. Oh. Okay,
there you go.
Okay. Again, the first thing we'll keep it pretty. We're not going to go deep dive, but we're going to goal is here to make sure to help you to understand a few things. So your first thing you need to do with yourself is everybody should pull their own credit report. And we have a site here by law is set up where you get your free annual credit report at least every 12 months to allow you to get your credit report, not your credit score difference. Credit report, let you know what's on your credit report. As you can see here is annualcreditreport.com is the website you can go to, and it brings up all three of the agencies that you work with, which is Equifax, Experian, and TransUnion. And everybody want to do what you want to do is, hey, want to review your credit report and see what's on there. The most common issues that hurt in your credit report are derogatory accounts, late payments, collections, charge-offs, and bankruptcy. And you see the website is annualcreditreport.com, allow you to be able to go there and pull your report up. It will come up individually. So you want to be able to make sure. And one thing about that now, you really can't, you must do it because the questions it's going to ask to verify you must know those questions. And sometimes a question may ask you, have you lived on Mockingbird Street, 1112 Mockingbird Street? And you have not lived there, and you may say yes or no, or you don't know. It's so important to make sure you understand when you read the question thoroughly and then answer the question that is asked you. Don't assume, but answer the question. Yeah, my professor used to say, read the question and then answer the question. Don't make up things up in your mind. Next slide. Second thing is about fixing your credit. So most people have a misconception about how to fix your credit. Fixing your derogatories, first thing you got to remember that your credit report, what's on your credit report is, if it's yours, you can't take it off. So don't think you can take everything off your credit report. It is your credit report. Credit report reports for 7 years, shows for 10. Only time something will fall off your credit report in 7 years is something that has stopped reporting or you have paid it in full. So understand that. Remember, it's stopped reporting. No, it's no longer reporting, or you have paid it in full. And again, you want to say making sure that you pay your bills as agreed on time, so therefore you don't have no derogatories. Anything that is in collection, contact them, the agency, and produce a payment and work out a payment plan. Meaning that you don't need to go pay someone to do this work. You really want to sit down, look at your credit report, look what's on there, and then call each one of them and try to work out some kind of agreement with them and figure out that you can do. They all want to settle it. Your goal is, hey, to figure out that and create a payment plan. It's not paying them. And remember, because they don't go away, because they may stop calling you. They may stop sending you information, and as well as company A, one of the things, big misconception people have is that, so it's like you have a Macy's account, and Macy's account, you didn't pay them, they charge you off. They charge you off, then they in turn sell you to a collection company. It's a collection company. And collection company may chase after you for maybe 6 months. They may in turn sell you again. Now, the key point is this, I want you to understand is that you don't want them to go to collections and you don't want to be sold, because one account can kill your credit. You can have an 800 credit score and one account, because it went to charge off, collection, and then collection can sink your credit report, your credit history. So really you want to make sure you're doing, work it out. So, but if you do go to collection, you may be mad, although you may be mad at them or something, but you want to call and work it out, work out some kind of payment plan, and then work and pay it there. And then once you do all that there, you can, okay, do that to each one of them. And then next step you want to do is try to establish a new account. And understanding, establishing a new account, meaning that you really want to go out and find, if you have an account that you feel comfortable with, you don't need to, building your credit is not by having a bunch of credit cards and then charge them all up. Misconception. Misconception. So building credit is how a credit depository works. Although you may pay the credit card company on time, but if you max out all the limit there on the card, you paying your credit score will not improve. It's really gonna go down. So making sense. So really establish a new account and then just work it out, pay them as agreed, not to charge a bunch of stuff, but just pay them as agreed. Next line. Now, this is the biggest thing with people, building your credit back. Once you have went down, your credit, you fell in the hole, and you had your life event happen with you, whether it be a bankruptcy, whether it be medical bills, whether you got sick, something, you lost your job. It happens. Life happens. We understand that. Now you want to say, how do I get myself back on track, get myself back in line? You want to build your credit. We're starting with the revolving accounts. Again, I was speaking about revolving account. Revolving accounts are anything that you have, like your department stores, your credit cards. Those are all revolving accounts, which basically takes the most points away from you, give you the most points, as well as takes the most points from you. So, but you understand, like, if your limit is $1,000, you can carry on that account that you're going to carry. Maybe you're not paying, you don't pay it off, is $300. So 30% of that liable limit. If you use more than 30% of that liable limit, although you're paying it as agreed, you will see your credit score will drop because you're utilizing more than your liable limit, more than 30% of that liable limit. So really want to watch those things with your credit card. So it doesn't mean building your credit, you go out and charge them all up. Don't do that. But you want to think about credit cards like cash. If you don't have it, don't use it. Or if you can't bill it, make sure you put it keep it in range where you can pay, and keep the limit lower than, like I said, 30% is, we think about, to do the math, say, hey, I can only use 30 from a carrier balance. I can only carry a balance of 30% of that money. Then learning how to minimize the inquiries into your credit history. Again, you don't need to apply for everything out there, or somebody offering you a free deal when you go to, like a lot of stores are offering you, when you're about to buy them, about to check out. They say, sign up for my credit card, you get $30, you get $30 or $20, $100. Those all inquiries. All may seem like it's a good thing, but really not. So you really want to make sure you don't do that. If you're trying to buy a car, typically most people walk into the dealership and let the dealership be the ones to do the shopping for you. That's not a good thing, because the dealership I call it a gunshot approach. They take your name and just send it out to everybody that they have affiliation with and see who comes back. But all of them are going to pull your credit. And that's always going to be a lot of inquiries. And again, that's going to negatively affect you. Because mind you, when you open a new account, anytime you open up a new account, when you open the account up, your score is going to drop because you open a new account, as well as those inquiries are going to drop your credit scores. So understand that. And then it takes about 90 days for those inquiries to kind of fall off. The dealership, when the new account you open, once you make your first payment, those points should come back to some degree, as long as you make it payment as agreed. So really want to make sure of that. And then learning how to opt out of third-party affiliation that may be a part of the creditor. Sometimes when you fill out that application, read the small print. There's affiliations a lot of times with most people, creditors out there. You want to opt out of that, because if you don't opt out of that, they will share your information with other parties they affiliate with, and those people will do a soft pull or pulling your credit. And so, sometimes you get those flyers. You say, "Well, I didn't apply for nothing with them. I don't have any relationship," but you do. If you have a relationship with a company and they have a relationship with them, they kind of share your information. So you want to opt out from that. So therefore, you want to try to control who's. So in summary of that, you want to control who sees your credit, who you allow to see your credit, and who you allow to be applying to. These are simple things, but it does make sense for you there. Next slide. And budget. One of the things we, again, like say, hey, one of the people like say, hey, most people live off their gross income, because they say, I make 80,000 a year, and you start spending just like that. But really, actuality, when you think about it, is your net, because you don't get $80,000 when Uncle Sam get their fair share. They take about between 33 and a third of your money before you can get your dollars, your net income. So you really want to realize your net, and then you want to make sure that you're only living off of between 25 and 30% of your net income. That gives you plenty of room to save, or to invest, or to put away for a rainy day. Because when you start going above 30% of that, you'll find that you have no money left over after your paycheck. You get to write all your bills, pay them all out. There's nothing left. And you say, well, why is that? You say, do the math. So you're spending all your money pretty up front there. So be careful of that, because remember, you want to live that. So you want to look like the best way to look at it, say 10%, look better to save 10% towards savings, 10% for incidentals, emergencies, and 5% plan for vacation, and 5% plan for, 5 or 10% plan for your not-for-profit or charitable tithing you want to give. And that's where if you're able to do that, you find that you will be in a much better position to do some things for yourself there. Brynn, you have anything you want to say? So, and therefore you your way of living will be much greater than you would anytime, because you're now in a better position, because you're after about 4 or 5 months, you see money in your savings account, you see money, you're planning for a vacation, you making contribution to something, your church or some organizations you feel good about, or you're making a donation to them, and those things you feel good about. And then we all feel good when we can do those things. That makes your life going better. Next slide.
Hey, Robert. I actually was gonna say something really quickly. I'm sorry, I was on mute and I didn't know it.
Okay, go back to that.
I apologize. On that budget, and I do believe that that's where our credit can crumble very easily. Because what happens is we start planning a lifestyle of maybe gross income, and then we get so far deep in a hole that maybe we do start taking out loans or credit cards. And that's kind of probably where a lot of people, in their 20s or right in college, might be to fail in that area, in this one area. So I was kind of hoping we can get some college kids on here. I actually sent this out to some places that I thought maybe invites, but this would be a great idea if you have college age kids or even high school kids, to talk to them about these types of budgeting practices when they get their first jobs, to talk to them about the taxes that are taken out. Okay, yes, a job is offering you, 25, 30,000 a year, but keep in mind, that's not really what you're going to be making. Teach them about what is taken out and where their money should go in the event, that they're getting maybe their rent or their food. Teach them about insurance and even, registration on our vehicles, things like that just kind of happen like once a year, and we don't think about them. And then we tend to maybe take out a loan or put stuff on our credit card and it's harder to pay off. So this is something we can actually start early on with our kids, teaching them these things before they go off to college, the budgeting end.
That's true, and here, because when you think about it, your basic living expenses is that 25 to 30%, which is what you speak about. Those what you want to, if you can live in that framework right there, you in good position, meaning that your rent, your mortgage, your car loans, things that you're doing falls in that 25 to 30% range. And then because you're right, you want to spend time with your teenager, your kids, your college students about this part right here, understanding, hey, that 25 to 30% is what you're really going to want to work out living on. That is your rent, your light bill, your gas bill, things, your basic things you need, your food, your shelter. So, hey, okay, because by the time you get it, that net, your health insurance and all that is already taken out of your pay stub. So this is what the net amount you're getting. So if I'm living with that, then I got 75% left of my net to do some other things I need to do. And that's really want to see. So, okay. So, hey, okay, I'm living that footprint at 25, 30%. So is it realistic? Well, it's budgetary. I mean, you got to budget. If you budget correctly, yeah, you're right. And then when you ever step out of that, it's very rare. Once you get used to doing things and living in that means, then you're able to plan your purchases, plan things like that. But you see the 10% towards saving, you may want to increase your savings. These are just basic numbers here, but you can increase those numbers if you feel you want to. But the better you increase those numbers, the savings, the emergency plan, the planned vacation, the non-for-profit and charitable things tied in would make your life much, much better for yourself. So you got a nice reserve. So, okay, next slide. Like planning your purchase, we just spoke about that. Be careful of who you take to the finance. I think Brynn want to talk about this one here herself.
Yes. Another, just area that can get us in trouble and cause that credit score to not reflect good purchasing habits is who are we getting our advice from when it comes to buying things. It's so easy to want to, I guess, keep up with your friends or even family. So it's important to make sure that you're getting sound financial advice. And sometimes it is necessary to talk to a financial advisor or even a life coach. There's a lot of people who maybe not have good, good, I for lack of a better word, I mean parenting or even good role models in their life to teach them about the importance of financial decisions. And so just make sure that the people that you're getting your financial advice from come from people who you can tell have good financial spending habits already. There is a important habit to get into to make sure that you know what the need versus your want is. We need shelter. Sometimes you need transportation if you don't have access to public transportation, or family members who can take you from point A to point B versus the wants. And we put in there the things that you can live without. We need clothing, of course, but the type of clothing that we're buying ourselves, can we get a basic pair of jeans that anymore, you can buy a pair of jeans for $200 or you can buy a pair of great jeans for $20. So it's getting into the habit of making sure that you get the most out of your money. Some people, clothing is very important to them, and so they have their more expensive designer things they want, but maybe in other areas they don't spend as much. Maybe the food they don't spend as much on. So it's all about kind of assessing, thinking about your need versus your want. And even in your wants, because it is important to give back when you're working hard, your vacations. And I always say, like, just spoil yourself, whatnot, with a manicure, pedicure, coffee, or an expensive dinner or something. but just make sure you keep that stuff in perspective and where you're putting your money. Make sure that you're planning your grocery trips, your TV purchases, have a budget, stick with it. I am awful about this, going into a store and there's a sale. I see something on sale. I don't need it, but it's on sale. And what about if it's not on sale the next time I come back in here? So it's really important to plan your grocery trips, to try to stick within a budget. It really helps from month to month to make sure that you're not overspending. So just thinking about where you're putting your money, planning your purchases so you can stretch your dollar as far as you can.
Yeah, well, that is true. The key critical piece here, if anything, they don't get anything out of this, is basically say, hey, spend a session with a financial planner. Just spend a time with a financial planner. Just, they don't, whether you do business, you want to say, here's what I want to do, here's where I'm at, and what do I need to do to move myself forward to have a great life now, but an awesome life when I retire. And knowing that, and to help you to understand that, how to set things up for yourself, and then but it's all about budget, but things that you can have things moving in the right direction. But you'll be able to one day buy those designer jeans, but maybe not today, maybe tomorrow, but not today. So that need and want is just that is a need is what you need to survive right now and make things work. But understanding that, hey, no one said that you can't one day be able to buy that designer jeans. But one thing I always tell people, everything goes on sale. Everything goes on sale. And sometimes you may be the sale shopper versus the first time it comes out. You may be buying things that are maybe a year or two old, but they still look good. So you may have to think about things. You think about things differently. And as your wealth grows, as your income grows, your wealth grows, you have more disposable income. It allows you to afford more different things. But the main thing is start planning your purchase plan. But the practice is planning your purchase. You find that your tomorrow will be better than your today. Next slide. Final thoughts. Each of the above categories will affect your credit. Understand that it will. So if you don't have money to pay your bills, that's going to hurt you. If you overutilize your credit cards, although you can pay them, but if you maximize the amount of money you have going out, you will put yourself in a position, because guess what? Life will happen and you can't make a payment one day. Not that your intentions was not to do that, but it did. You may lose your job. You want to set up that 6 months of savings for yourself, or maybe a year savings for yourself, that you always have that reserve. So the whole goal is building that reserve. If you have a big purchase plan, get the most value out of your dollar, really. So that's where you want to look at. Say, hey, well, my credit is great. I got excellent credit, 800, 750, 850 best credit score you can have. I'm in the 700 range, the 800 range. I'm doing very well. I'm my dollar now. My dollar is worth something to me. Versus if my credit scores are below that, the less and less of my scores, the less dollars I have access to utilize. And you say, wow, okay, so so typical person make only with $1. Yeah, and your dollar, and if a person with a 600 credit score or lower, that dollar's maybe only worth about 40 cents when you get in there. It's like, wow, nothing to do. And the better your credit, the better your insurance premium and loan rates you would get. So you wouldn't have to worry about what's my rate, what's the premium you're going to charge me. You be able to qualify. We better, someone like myself and Bree, we be able to present you with the better options that allow you to do it without having to figure things out, but maybe show you that and show you what you qualify for, and show you how much your money can go for you, and you have the best policy that you ever get, or the best loan rate you ever can qualify for. Bree?
Yep, that's something that I wanted to definitely emphasize, was the better our credit scores, the better your premiums are going to be. And it starts early. So the earlier we can get young adults to understand that their spending habits start practically right away. And, unfortunately, they're so young, but it does matter. And so if you want, if you don't want to spend as much on your insurance rates, or if you want low interest rates, just keep that in mind, teaching your kids, or even yourself, is something I'm learning too the older I get. Just manage our money well and making sure that we're keeping in mind our credit score affects so much more. It's not just a score. Unfortunately, it's become so much more in our society today. So just be aware.
Yes. So, so in summary, they say, hey, hopefully these steps, these are not all the steps, but, we can go really deep. We try to keep it very simple of the things that the key critical pieces that will help most people right away. And if you have any questions about anything we say, or what, please, definitely reach out to myself or Bree, and we'll be able to talk to you, help you to understand some things, answer your questions you may have.
We didn't want people to run away when they saw the PowerPoint or when they heard us talking. So we try to simplify it and, just kind of go over the key points of importance, just the basics, the fundamentals. So there is a lot more to it, but this is definitely a good foundation to start on.
Yeah, we don't want to chase you away. We want to make sure that you have some key points some basic points to follow through to help you to get yourself into the starting position, so you can be great, doing some good things. Again,
yeah, I was just going to say, I'm sorry, you are opening it up for a question or two?
Yes, ma'am.
Okay, just a question, and I know, I think I don't think you said it, but I wanted to, so you too, in your different professions, you would help somebody look at and what they could do to make it better, their credit, probably help them not doctor it up, but make it better. I don't want to sound like, but you could help them. That's part of what you do, right?
Yeah, we definitely help them to understand where they are, and once to understand where they are and what they need to do to move themselves forward.
Okay.
So long as then again, it's just a matter of, do they want to do the work?
Okay. So I've heard and then this is kind of leading to the question, what do you recommend? And I know we've probably all heard different things, but is it a good thing to close a credit card? You pay it off, you close it. Maybe I kind of know, I think in the back of my mind, I know the answer, but let's say you've had a credit card for years and you've paid it diligently and you've now got it closed, or you've got it, not closed it yet, but you've got it down to zero. And you're, pretty proud of yourself. Is it a good thing or a bad thing to close that credit card?
Bad thing to close your credit card. You do not want to close your credit card.
Okay.
Credit card. Remember, your credit score grows based upon one, the limit that you have, the credit limit you have,
right?
The time you had the card. I mean, time history with that. Those plays your scores, affect your scores, make your scores better. So when you close the account, it drops your score. So really,
right.
your goal is not to close that account, because that helps strengthen your credit score.
Okay, so it's that relationship too, right, Robert? Isn't it that part of that you've built this relationship? I mean, it's so tempting. I mean, I haven't had it happen that many times in my life, but let me just say, it's really tempting when you have that situation. It's like, I'm going to get this thing off my credit report, and then you're like, should I do that? And you know what? I don't know that everybody's always thought that. I think I've heard that from some other people, financial experts. I've heard that, don't do it, but has that always, maybe you guys don't know that.
Yeah, that's always been the case. So you keep in mind that if you don't use the account for at least 12 to 18 months, it will self-close. That's not going to affect
Okay.
you.
All right. Well, that's
typically what, if the lender have not seen you have utilizing it, you're not utilizing the credit, they may reach out to you a few times. But then sometimes they may just say, well, although you've been with them a long time, you've been using it, and you may go dormant. They may not close it right away, but they may, if 18 months or 2 years, no activity, it may self-close it. They may self-close it that way. So because you're not for inactivity. but you don't want to close your account because remember, you built those account, you built your credit footprint up. So, you know, you have established credit and you have established a good credit score. So, you know, and I always tell people, most places out there takes a MasterCard or a Visa.
Right.
So do you need everybody's credit card? You do not. Because remember, the more credit you have out there you can utilize, if you're not disciplined, you typically will use it. Or you may let someone else use it. And those are not good things because now you're spreading yourself pretty far. And although the creditors give you the credit, but you think about your income. So, well, my income is X, but I make 40,000 a year. I have access to 200,000 over for credit. You know, do I go use all that? No. So some people are not disciplined enough. But the good news about that, if you have that access, that means you have a good credit history. You just don't need to use it.
Although I'd have to agree with Brynn. If there's a sale, man, come on, there's a sale. I gotta spend my, I'm joking. I don't do that. It's very tempting to do it, but you guys, that was great. I don't know. Anybody else got questions? Nicole? No? Okay, well,
I do.
Oh, there's Dawn. She's alive. Yes.
I really appreciate the both of you, Brynn and Robert, sharing this information. And I heard you say earlier, ideally to have 25 to 30% of your income for your living expenses. I think that helps people, you know, be in good shape to be able to have the rest of their income available for those emergencies and savings and other things. I know a lot of people today, you know, in an inflationary economy, coming out of an economic downturn, aren't in a position to limit their living expenses to that amount for whatever reasons. So when their non-discretionary expenses are really significantly taking up a huge portion of their monthly income, they can't afford a financial planner, necessarily someone to go to. So I'm wondering, what resources do you recommend for them to get some sound advice? And I know that there are some tools that they might be, you know, at their access that would help, like secured credit cards or community home improvement grants, or you know, shopping at consignment stores, doing a staycation, using a food co-op, etc. But where do they go to find out more to a resource that they can afford, that's not a you know, a financial planner that they have to then, you know, pay some more money to, but a trusted individual to give them that guidance?
Well, misconception is most financial planners charging you for a consult. They're not. The only charge is basically when you're actually putting money in their portfolio. Their goal is really to help you to get you in a position where you can open an account where they can be your financial planner going forward. So they will do a consult with you to help you to understand how you can restructure some things for yourself to help you to start making that savings, making it so showing you identifying what you really need, what your needs and your wants, and where's the I call it the fluff is at. And I mean, you don't have to be the one. Like the misconception, I want to be able to put away $400 or $500 a month. Well, that's not realistic. Your goal, if your goal is you can put away $10 a month, you're moving forward. So the goal is to get to restructure some things for you to get you in a position where you can do it. So let's I will say better, think about your footprint only and focus on your footprint only and save and work out the plan that makes best sense for you, not what someone think it is. And a financial planner doesn't mean that you got to have this huge network. It's really trying to see there's different financial planners. There's high network financial planners, and there's simple, more common financial planners that's really trying to help the common man, trying to help that person, the working person, become a client for him. And it's to their benefit to help you. to their benefit
So
to help you.
where do they find that financial planner?
Well, again, I know a few of them out there, so they want looking. I definitely will share people information, because there's financial planners. Again, if you're going trying to high net worth people, there's financial planners all over that working with simple people that work every day that don't maybe need to help you to restructure, so you can start putting that in, making that savings and making that investment towards yourself for your tomorrow.
I think it's a good question, Dawn. I think the majority of our members that are financial planners, I don't think they charge. I don't think they do. It's kind of like, Brynn and Robert both, and you as a travel agent, you guys don't charge your people, but when you help them set up some kind of a trip or an insurance policy or a mortgage, then you get compensated for whatever you've helped them, but it's coming from the vendor or the provider, right? Isn't that the right way to look at it? So I don't know. I mean, Dawn, there might be, I don't know. I don't think I've ever run into them in our network, but I'm not saying that they don't. I mean, the financial planner we work with doesn't charge us. Now, I know he makes money, but we put money into accounts, and he would get a commission from the company that we have now put our money into, if that makes sense.
Well, the whole goal, remember, a financial planner only get paid for the service they render, and they can't. Their goal is to really get more clients in their portfolio. And think about it, there's a huge network of people that do not have any kind of financial plan whatsoever.
Right.
And it's to their benefit to help counsel that person to get them in the position, but maybe not today, but tomorrow, to be a client. And how to become a client? They got to create some income, create some money for them to be able to use. Who better yet to show them how to create the network? And also, you can talk with you if they have an accountant. So you talk to the accountant once a year. Have you got a budget? Just once a year. Don't go just on tax day. Go once a year to them to set up something. Hey, Mr. Accountant, help me to understand where I'm at here. And they have just a one-time account, and not just on tax day, but go, I would say, the first of the year. Hey, 2021, right? So how can I make 2022 or 2023 better for myself? Here's where I'm at. Boom. And they, again, just take advantage of the consult, where one-time consult. When you start coming back over and over again, they're going to charge you for a fee there. But the first time, they get things set up for you and you move right along. But there's a minimum. So don't discount the financial plan. Don't discount the accountant. Don't think they're going to charge you. They're not. They need you. They need you, your neighbors, your friends, cousins, all that. Who you make money. You're working, just that you may not be doing it correctly. And here's the one you get some advice to help you to become a client of theirs.
Good to know. Thank you so much.
Yeah, that's good stuff. I sound like Cody Bateman, don't I? That's good stuff. That's good stuff. It really was. It was great. Thank you, Brynn and Robert. Very awesome. We're gonna we'll post this out, and both of Brynn and Robert are members, as well as Dawn and Nicole and I are all members of TTR Networking. So we'll put a link in there for that. And thank you guys very much. It's wonderful, and just nice to know that there are people out there doing the work you guys do, and that you're happy to help. I mean, instead of, just like Robert said, we all need each other. So I do know, Dawn, real quick. I know that there are financial planners that only want to work with people who are in a certain income range. So that is something, but I don't think the majority of our people that we've come across in the financial world fall in that at all. They're really trying to help anybody. If you could put maybe not, can put $50 away a month, that's a great place to start. So
I agree.
Santiago, Nicole, Santiago, he does that. So there's plenty of them out there. It's just that there's high net worth financial planners, and they chasing those, and you know who they are. And then there's the other financial planner who's really they looking for a client to help you
Right.
to become who they, because no one knows what your tomorrow may bring. You may be just starting off college, jump out of grad school and ready to go to work. You got nothing. You got,
Right.
but you will, but tomorrow you will. And you have people that's working that have the net, have making the money, but just have it all over the place. They're not being able, they need someone to help them get some structure there to help them to get them in a position where they can start making that be a priority for them.
Yeah.
That's all. So,
and I think we're good.
So if anything, accountant, find your accountant, find your financial planner that's willing to sit down and do a consult.
And then talk to Brynn and Robert and then go on a trip because you've got all this money that you saved. There you go. And Nicole and I will be here to talk with you after that, whatever. Thank you, guys. This is great. I appreciate it. I'm going to turn off the recording.